Hi everyone, my name is Birpal. Today I'm gonna present a presentation about recognition of intangible assets under IAS 38 or AASB 138. Introduction. This presentation explored the recognition of intangible assets under IAS 38, focuses on the complexity and the challenges of identifying, measuring, and the reporting intangible assets like brands and R&D, examines the difference between acquired and inter, internally generated intangible assets and the role of professional judgments, highlights real-world examples from companies like Alphabet and Coca-Cola to illustrate practical challenges, discuss the importance of corporate governance in ensuring accurate transparency in reporting. Now, what is the intangible assets? Definition is that an identifiable non-monetary assets without physical substance, such as assets is identifiable when it is separable or when it arises from contractual or other legal rights. Separable assets can be sold, transferred, licensed, etc. Examples: brands and trademarks, software research and development, importance critical to the success and sustainable growth of business in the modern economy. Rising significance, intangible assets are increasingly valuable in knowledge bases industry where innovation and intellectual property drive success. Accounting Standard for the Intangible Assets (IAS 38) Standard Guidelines. It offers the structure needed to identify, quantify, and disclose the intangible assets. Recognition criteria for this one is must likely provide future economic benefits and be reliable, measurable. Measurement for this one: acquired at post and internally generated assets follow specific criteria. Disclosure requires clear reporting to enhance understanding of the whole assets role and value. Objective: promote uniformity in the accounting, ensuring transparency and comparability across the financial statement. Recognition criteria for the intangible assets: future economic benefits. Assessed must demonstrate the potential to generate certain long-term economic benefits. Reliable measurement: the assessed costs need to be reliable. Expense treatment: if recognition criteria are not met, the cost is recognized and as an expense not assessed. Specific for internally generated assets, additional rules apply to between research phase and development phase. Acquired versus internally generated intangible assets. Acquired intangible assets mean typically recognized at some cost, like trademarks, customers, relationships. Internally generated intangible assets more complex, subject to specific recognition criteria, must distinguish between research phase and development phase. Goodwill: internally generated goodwill cannot be recognized under IAS 38 to valuation challenges. Internally generated intangible assets R&D research phase. At this stage, costs are considered expense, not assessed. Development phase is cost may be capitalized if criteria are met. First one, like technical feasibility of completing the assets. Second, intention and ability to use the sale of assets. How the assets will generate future economic benefits. Availability of resources to complete development. Reliable measurement of costs. Challenges: identification difficulty. Intangible assets are abstract making them hard to define and separate from other assets like goodwill. Valuation uncertainty, establishing reliable fair value is challenging, especially when no active market exist. Economic benefits, like difficult to predict future economic benefits, particularly for internally generated assets. Expenses versus capital. Determining whether expenditure should be expended immediately or capitalized required significant professional judgment. Implications. These are implications should be applied for this one. First one, financial reporting impact. Inaccurate recognition can lead to misleading financial statement and misrepresented representation for this value. Second one may be investment discussion. Investor may be affected by undervalued or overvalued intangible assets impacting their decision making. Third one would be like strategic planning. Companies may face difficulties in strategic planning and resource allocation due to the uncertain assessed valuations. Fourth one, audit and compliance. Auditors must navigate complex judgment and ensure compliance with IAS 38, adding to the auditing burden. Real world example. First of all, like Google, R&D investment recognizes development cost as capitalized expenses. Challenge would be rapid recognitions advancement make forecasting future benefits and difficulties. Like Pfizer, drug development costs are capitalized only when success is reasonable certain, otherwise they are expensed. Challenges would be uncertainty in drug development and expiring patent. Uh, Third one example is Coca-Cola. Brand value. Brand is a key of asset, but cannot be recognized as in internally generated. Here will be challenge would be dispensary between the actual company value and the financial statement representations. And same like the fourth example, software development for the Telstra. Capitalization of development cost if criteria are met. Challenge fast evolving technology sector and the valuation of the future economic benefits. Implication for the stakeholders, investment decision. Accurate reporting of intangible assets is crucial for making informed investment choices. Financial analysis, mis misevaluation or mission of intangible assets can destroy a company's financial health and performances. Strategic decision, investors and management may struggle with strategic planning if intangible assets are not properly valued or recognized. Risk management, proper recognition help in assessing risk associated with this impacting risk management strategies. Implication for auditors, verification challenges and judgmental requirements, audit trail and regulatory scrutiny. And the corporate governance implications, transparent reporting. Strong governance is essential to ensure that intangible assets are reported accurately and transparently in financial statement. Judgment accountability. Boards and management must exercise accountability in their judgment regarding the recognition and evaluation of intangible assets. Sensitivity analysis, impact on financial statement, changes in the recognition and the valuation of intangible assets can significantly affect the financial statement, profitability, and the assessed valuation variability, shareholder equity effect. Variation in intangible assets recognition can influence shareholder equality, affecting investment decision and company valuations. Conclusion is this: complex recognition, real world impact, stakeholder and auditor implications, governance importance, sensitivity analysis. Like changes in the intangible assessed recognition can the for affect for the financial statement, profitability, and the stakeholder equality. Here are the references which we use for this one, and thank you everyone.